Welcome, everyone. Get started. Again, I'm Ian Fisher, co-founder and COO, joined also by Brad Johnson, co-founder and CIO of Vintage. Very excited to be with you all today. Thanks so much for joining. We are eager to talk to you about what we're seeing in the manufactured housing mobile home park space. So without further ado, I'll turn over to Brad. We're going to try to make this as interactive as possible. There's a questions box, I think, that you'll see off to the right. Please feel free anytime to type your questions in there. We will try to cover as many of those as we can. Apologies in advance if we don't hit all of them. Try to follow up separately for any that we miss. And so over to Brad.
All right. Thanks, Ian. And thanks, everybody, for joining us today. This is Vintage Capital's Mobile Home Park Fund, and it is a diversified portfolio of mobile home parks. And we are doing it in what I believe is a recession-resistant asset class. And that has definitely proven in my own personal track record and history in the space, in our investing careers. And then if you go back even 20, 30 years in mobile home parks, that has certainly proved out. We'll dive into that. In addition to all the other fun aspects about mobile home park investing as we go through this. And if you think of questions, go ahead and type them in as they pop up, and then we can address them hopefully for quite some time after we get through a fairly quick presentation. So let's get into it. All right, the fun legal disclaimers from our securities attorneys, of course, have to present this. So who are we and what are we offering here? So we are an investment team that has a proven track record in this space of investing in mobile home parks. I started investing in parks in 2013, which, while that wasn't a lifetime ago, it certainly feels that way from the standpoint of mobile home parks were certainly not as popular in 2013 as they have become over the last few years with investors, which is a great thing. And we'll get into some of those benefits, but it is becoming a more institutional asset class, which is desperately needed. But there's still a long runway to go. There's still mostly mom and pop operators in this space. And it's just now starting to become more institutionalized in terms of professional property management and more capital coming to the space to actually improve these properties, which is desperately needed. So a seasoned and proven track record over a life cycle of deals across good times and bad, in recessionary periods and in boom times, over multiple funds, producing top tier returns, no capital calls in the funds, no misdistributions in the funds, unlike a lot of groups that ran into trouble with floating rate debt in their funds with their apartment syndications and had some difficulties. We bypassed that in our funds because I think we were disciplined, and we can get into that with our track record. And now it's the right time to start purchasing a lot more deals. We are now raising a fund here today, which is tax efficient in nature, which we'll touch on. And we're projecting a 15 to 17 net IRR based on what we're seeing in the market today and what we think we're going to be able to do with those proceeds. We're not just making this up. Put the first money to work in the beginning of 14 in a small deal in Kansas that went very well. And then I gradually improved. The properties started generating returns and started doing larger funds over the next 10 years. I think we were pretty disciplined in putting this capital out and not just backing up the truck when it was the easiest to raise money, frankly, which was 2021, 2022. And we didn't raise a new fund in 2022, 2023, because really it was tough to do deals. It was tough to find reasonable deals that hit the underwriting standards that I wanted to see for an existing park. We had a track record of doing this across multiple time periods, generated great return, think about it on a risk-adjusted basis. In the funds in particular, I don't think that there was any real risk that we were going to lose our investors' capital when you're talking about 10 plus properties in a fund that is conservatively leveraged with fixed debt. It's very hard for me to imagine, just knowing this space so well and knowing how reliable the income has been over the years, it's hard to imagine those deals just blowing up. And so when people talk about risk-adjusted returns, it's nebulous at times, right? Because you can't apply a number to it. You can't say, oh, this standard deviation like you can in the stock market. But in private real estate, you can't really give a specific number. So you have to think about risk as what is really the likelihood that this is going to lose money. And I would argue mobile home parks being the most recession resistant asset class out there, these returns are quite good on a risk adjusted basis. All right. And we're not talking about trailer parks here. We're not talking about dirt roads with a bunch of beat up homes where you feel unsafe walking into these properties. And this is a big one for me. I definitely don't like the idea of investing in rundown properties and trying to squeeze every ounce of cash flow out of the asset and not reinvesting into the parks. I am very big on we're going to raise as much capital as needed, and we're going to invest in properties that we're proud of, that the tenants are proud of, that show well to lenders, to investors, to the tenants, to city officials, and are run by really good boots on the ground teams, and are not, as some people might do in this space, they try to do it from 3,000 miles away with somebody that's making $20 an hour and that lives in the property. Generally, that's very hard to do, right? You need institutional systems, you need people in place, you need teams that are regional or local to actually oversee these assets in a professional manner. You can't just do this based on a thesis. This is an operating business. It's not something that you can just trade on in the stock market because it's a good idea and it has good fundamentals in a thesis paper. It is a heavy operating business. And so you need teams and people and capital in order to run these things the right way. And that's something that we try to take pride in and focus on. All right, leadership team, Brad Johnson. I have been in real estate for quite some time here, both on the principal side and on the sell side, investment banking side, is where I started my career with Eastfield Secured, which is Wells Fargo's real estate investment bank. Learned a ton there. It's actually when I realized that mobile home parks were such a unique asset class, is because I saw that we were looking at loan tapes, which is just a long list of commercial mortgages. You could see that the lenders kept wanting to add mobile home parks to these loan portfolios. And I was like, why is this? It's just a younger guy. And they would say, these have the lowest default risk and yet the highest debt yields, which that doesn't really make much sense. Usually it would be the opposite, right? The highest debt yield would tend to be the most risky assets in a loan pool. And that's not the case in mobile home parks. And so that was when I went out, found a partner, and we bought a bunch of parks across the country and did quite well and sold when things got a little crazy in 21. And then Ian, you want to touch on your background?
Yeah, for sure. So I come from a management consulting background. I started my real estate investing career focused on single family rental homes. In parallel to that, I've always had a real fascination with manufactured housing, mobile home parks, just love everything about the space. So Brad and I started working together in this space now about 5 years ago. And I'm responsible for the operating side of what we're doing. And we'll come to what that means as we go. We're actually working with additional operators, but within Vintage, the nuts and bolts of what we're doing is our responsibility.
And really, Vintage is born out of our experiences as boots on the ground operators in wanting to upgrade the level of assets and diversify our assets as opposed to doing one-off deals, which is a great way to try to maximize a return on one asset. But the range of possibilities on whether or not you hit a home run or you lose it all is much wider than a fund of high quality assets run by professional management teams. And so we are very much in the mindset of do not lose a penny of capital. And so that's everything that we do is focused first on that. And that is namely through the diversification and not over leveraging the assets, fixed rate debt. But that is square one. That's what we start with. Because when I was starting out, I would sign personally on loans. I would put money into one particular deal and it just had to go right. And frankly, sometimes you got to get a little lucky and avoid weather events, which I've seen a plenty of in my fund, which thankfully the fund has a way of diversifying that risk. So anyways, Vintage is born out of those experiences with investors into great high quality deals in a diversified way where we feel like we're just going to keep compounding and don't have to start over. So why invest in manufactured housing? It's a heck of a business, number one. So you have declining supply. These parks are very difficult to build. It's difficult, as you can imagine, to get a city to approve a new mobile home park. And there's a few reasons for that. One, it takes up a lot of space. Two, it has a negative stigma to it. It brings out the pitchforks when people hear that a mobile home park, even if it's a manufactured housing community with newer homes, it looks like a subdivision. People understandably hear mobile home park and think the worst possible property, which is not what we're talking about here. But it just means that it's difficult. And so supply does not increase. You do get a few parks built across the country every year, but that's a few, right? Whereas apartments, you're talking thousands of apartments are being added every year. Doesn't mean that it's not a great asset class. It just means it is more challenging thinking about new competition. Then what's the other side of the equation? Demand. We have an affordable housing crisis in this country. Most of us are on this call. If we have the time and luxury to be on this presentation, we probably are not part of that problem in terms of trying to find affordable housing. But if you are making the median wage in this country and you're trying to find a median home price of $440,000, most people can't qualify for that these days. And so we just do not have enough new supply in the affordable housing sector where somebody can pay 500 lot rent. So there's a huge tailwind of demand for affordable housing and for mobile home parks specifically. And that's in part because these aren't apartment buildings where you have somebody on top of you, on all sides of you. If you have a young family, that's tough. It's tough to raise a family in an apartment building, even if it is a pretty nice apartment building. And so there is a ton of demand. And once again, with a fixed or declining supply, that's a pretty good combo. You don't see that combo too often. And I'm not the smartest guy in the world, but Econ 101, declining supply, increasing demand, your prices are going to continue to go up for quite some time. Recession resistant asset class, just really a function of what I just talked about. And it's countercyclical, right? Because if you have a booming market, people who are in apartments are doing well, the economy's doing great, they're getting a raise, then they can actually upgrade to a mobile home park and own their own home. Maybe it's a $80,000 single wide, and they can get out of that Class B apartment and upgrade their lifestyle for their children. And then on the opposite end of the spectrum, if you have a 2008 scenario where you have people losing their jobs, times are not well then you have people downgrading to mobile homes. It's really the last stop on the housing train. If you're going to own your own home, there's nothing cheaper than the mobile home. So you get it on both directions, which is proven out in the data, which we'll show you in a minute. And then this fourth point here, capital light compounding machines. That just means once you get a property up to snuff, once you improve the roads, you improve maybe some of the deferred maintenance, and it's at a steady state, they don't require much capital. This is generally land, roads, pipes. That's about it. We don't own the majority of the homes. We don't own the toilets. We don't own the appliances. There's no giant facade like an office building that could fall apart. There's no giant roof like an industrial building or a retail center. There's no HVAC units that need to be replaced. The giant part of investing is making sure you nail that capital component, because that's below the line. That's below net operating income. And if you don't get that capital part right on any investment, it can really throw off all your cash flow and tank an investment. All right, so narrowing in on some of these points. Number one, the declining supply. Here it is in the data. We've talked about cities not wanting to approve these things, NIMBYism, not in my backyard, pitchforks come out, and that leads to very low numbers. So every other major sector in real estate sees increasing supply every year, while manufacturer housing is effectively zero. Like I said, there's a few that do get built every year, but there's way more that get demolished. And generally those are on the lower end. Those are more trailer parks than brand new, beautiful manufactured housing developments, but still that equates to a zero net new supply coming on each year. And so as a investor, that's a good place to be, right? You don't want to be always focused on new competition. It's terrifying when you buy an apartment building and then hear that just down the street, they're building a brand new Class A with better amenities than you and are coming in at a lower basis because maybe you bought at peak market. That's a tougher place to be. That's more of a knife fight. Whereas with mobile home parks, you always have this underlying support of the business model, which is extremely compelling due to the supply-demand imbalance. Here's the data on being recession resistant. Because of all the things we talked about, it just doesn't fluctuate. Demand and net operating income does not fluctuate. So this acts as a nice counterbalance. This is a diversifier in a portfolio when the stock market's tanking, when the economy is not doing well, when perhaps an apartment building, you're losing occupancy because people are losing their jobs. Mobile home parks are not sensitive to that. And a lot of that is in not only the fundamentals that we've talked about, but it's also because there's just a lot of room in the lot rent, not such that you can just jack these things to the roof, which we'll touch on, but you can raise lot rents methodically for a long time. There is a ton of room, the big delta between a $500 lot rent and an average apartment rent of $2,000 in some of these markets. That's a lot of room. Obviously, you're not going to do that over a short period of time, but That's a decade you can take to just increase that. And that assumes that the apartment rents aren't growing from there. So it's hard to imagine why this dynamic would not continue for some time. The compounding machine aspect of it has to do with the fact that you own basically a parking lot of land infrastructure. The tenants own the majority of the homes. We do getting into the home business as a strategic value add, and then going back in our investments and having the local player go ahead and sell the homes back to those tenants. That's a way to quickly infill a property, but still, you're not going to own more than 50%. You're usually the most you get up to is 30% of a property. And if you look at the portfolio, will be a fraction of that in terms of the amount of homes that will be owned. But because you own that pad, that land, there's just not a lot of ongoing expenses. And number two, the pricing power. We talked about the supply demand and the amount of lot rent that you can push before you're anywhere close to apartments or a mortgage on a home. That's even a wider gap. And so that leads to predictable increases. And then number three, because you're not throwing a bunch of money back into the property after that initial couple of years where you're improving the asset, because you're not constantly dumping money into leasing commission, tenant improvements like you would in industrial, retail, office, hotel constantly needs new capital. It's a lot more volatile. Here, you're just not having to contribute that much more capital. And so you're able to generate more cash flow, which can either be made as distributions, right? So distributions can be increased pretty quickly over a fund's life, or you can reinvest back into maybe buying a few more homes to increase occupancy in a particular property, or you can do an expansion of a property and actually lay down concrete, put in pipes, and expand a park maybe 20% if there's some excess land. And you see this in the numbers. You see this in the data where mobile home parks have been the best performing asset class for the last 15 years because of this dynamic of being able to constantly grow income as you get at this compounding effect. Oh, and the tenant turnover point is that this 2%, that is the actual home in the property. And that's how I think of the tenant. The tenant is the home for each individual asset. Sure, obviously you want to take care of the people inside the homes if they have issues, and the property management teams need to be a tenant to that. You can't just ignore them. You have to run a full property management service. But if you think about it just as an investment, the homes rarely ever move. We're talking about 2% a year turnover versus upwards of 50% for apartments. And so you're not getting those turnover costs. When somebody leaves an apartment, you have to go in, you have to redo the carpet often, you have to paint it. Sometimes there's some damage. Whereas in great markets for mobile home parks, you will have a person leave the home and they won't even tell you. They will actually sell their home to a family member or a friend. And that, once again, just leads to all the capital light and reliable income dynamics that we've talked about. More points, won't dwell on this because we've talked about some of these, but deep demand, we have tax benefits. Depreciation is incredibly attractive in this space because you can do bonus depreciation on land improvement. Now, there is some legislation going on whether or not they're going to increase the bonus depreciation back up to 100%. So we're not going to make any projections this year about what that's going to look like. But even if it never passes, which I think is unlikely given that the House has already approved it, but if it doesn't pass, you still get the benefits of the depreciation to shield cash flow. So even if it goes down to 40% next year and then down to zero in a couple of years, no more bonus depreciation, you still get the benefit of that accelerated depreciation per year that would be shielding the cash flow, which is amazing, unlike a commercial asset that is 39 years, which you don't get to enjoy much of a tax shield from that depreciation at all for a commercial asset. Attractive long-term debt financing. Fannie and Freddie are very big in this space, especially at the higher end of the properties that we like to focus on, where they are subsidized effectively by the government. And so you get favorable rates, interest rates, you get pretty flexible terms. There's a nice feature where you can actually pull out refinance capital fairly easy without accruing a bunch of new fees and a new loan. So that is a very attractive component of this space. That wasn't always like that. Counter-cyclical, we talked about sticky customers, we talked about in fragmented market. Now, some people, when they hear that times were good in 2013 and buying was great and there wasn't as many people focused on the space, while that is true, I am surprised at how long of a runway we still have And I've seen it in the deals that come through. I thought that once the private equity guys started coming in, the Blackstones, the Carlyles of the world, once they came into this space, I assumed that it would be very difficult to find any deals. And maybe the low hanging fruit is gone, whereas it's very tough for somebody that has zero experience in the space to come in and buy 15 parks in a few years at good returns and then actually operate them. That would be the hardest part of that equation. You can find a small deal, one deal, and make that work on good numbers because there are a lot of still pops in the smaller end of the market. If you're trying to go out and find 300 pad parks, all tenant-owned homes that are 100% occupied with city water, city sewer, direct billed to the tenants themselves, so you don't have to even deal with the utility metering, good luck. That segment of the market is very challenging without a deep network of brokers that have worked with you before, without knowing a ton of the operators in the space that might bring you deals because they know you have capital. So that side of the world is tougher today to enter. But there's still plenty of runway to go from the 40,000 mobile home parks that are 80% owned by small one-off mom and pop operators. That's a long runway. There's still a ton of deals out there. It's just you certainly have to work, I think, harder to find them at scale versus just finding one-off deals. All right, case studies. So let's make this a little more real in terms of, okay, here's an actual property. Bought this one in 2016 for roughly $4 million. This was in Wisconsin, right on the edge of Duluth was the MSA. Minnesota, Superior, Wisconsin was the actual city. We tend to think about mobile home parks in terms of the MSA because you want to be able to pull from a wider market. You want to look at those statistics versus just a particular city because people will drive a long way, up to 30 minutes typically, sometimes 45, for affordable housing in a strong MSA. What you don't want to do is go 2 hours outside of an MSA in some town you never heard of with 3,000 people that doesn't have the income or the jobs to support these rents, right? And I see people fall for that all the time, where they think, hey, the thesis is so strong in this industry, this is such a great investment that I can almost go anywhere nationwide. You still have to go to real estate fundamentals. You need job growth. You need high incomes. You need a reasonable employer base and a healthy economy. So anyways, back to this deal. This was a pop owner. He was like the mayor of this property. He built it. He'd owned it for, I think 30 years. He was still doing mowing the lawns. He was the property manager. He was the account. He did it all. And he took a lot of pride in the asset. And he did well. He picked a great location. Walmart ended up building right next to him, which is always an amazing sign for a mobile home park demand. But what we ended up doing with this deal, the reason why it ended up working out so well was not cap rate compression. As you can see, we bought it at a mid-6 cap rate and sold it basically for the same cap rate 5 years later. What really improved this deal was incrementally increasing the lot rents, not jacking the lot rents like a couple of operators do in this space, which is awful, but incrementally increasing the lot rents and improving the expenses, passing through water, which reduces the water usage, cleaning up some of the ancillary insurance line items, removing some of Pop's expenses, right? He's got an extra car in the P&L, which is not a real expense if you're a professional operator. It's a real expense to him, and it helped him shelter some income. And it also helped him employ his kids, which he threw them on the payroll. So there's some weird things when an individual is operating a property that you are not going to do as a professional operator. So all those little tweaks here and there, and then increasing occupancy by bringing in some newer homes. Not a ton. This wasn't a wholesale, like, hey, we got to get rid of everybody and bring in 100 homes. This was incremental occupancy improvements. But all that is pretty powerful when it all adds up over time. And so we were able to dramatically increase the net operating income and get a great outcome over a relatively quick amount of time. And these are just some more pictures of it. So once again, not a trailer park in any way, shape, or form. High quality, affordable, safe living. You wouldn't mind putting grandma in here if she desperately wanted to live in this town and had a very thin budget. Second case study, Wichita portfolio. This was purchased for $10 million. This was a portfolio of 3 properties. Most of the pads were in 2 of the assets. There was a smaller add-on deal that we bundled together, which is actually a pretty good strategy. Is you can tack on deals in one particular market, and then you get a little bit more of a scale benefit when you go to sell it. But off-market deal, another pop owner that actually developed the park with his dad. He was doing very similar things to the other owner on his expenses, which is why you see the 2.6 cap rate. Obviously, that's tough to finance, and that doesn't look fun from a buyer standpoint. But of course, if you get into the numbers, you start to see opportunity in things, how you can run the asset differently. And that's why I tend to not over index on cap rates in this space. People, they always want to hear that first because it's shorthand. It's like a quick way to, oh, okay, it's a 5, it's a 6, 7 cap rate. I can get a sense of what the value is, at least from day one. But frankly, it's meaningless at a lot of properties in mobile home parks because there's so many dials that you can turn to improve that number. And so that's been a limiting factor the last few years. It was 10 years ago too, a deal like that with such a low cap rate. The hardest part is actually getting the financing for it and explaining all that to the bank. They just look at historical numbers and you're only going to go over what the trailing 12 NOI is. Maybe you can massage it a little bit by pulling out some just egregious expenses. Like I think this guy had a souped up Escalade. But anyways, we did some unique things with a bulk cable contract, which was a bit of a weapon here because then all of a sudden our lot rent was much lower than everybody else in the market. And this is actually a tougher market for mobile home parks because there are more institutional owners, which is really rare. In most markets, you only have maybe 2 institutional groups. And so we were able to, once again, improve rents, cut expenses, and we didn't do much in occupancy. This was more of a buying and tweaking the expenses. And we're able to sell it in 2020 for a great number. But once again, we didn't do this through cap rate compression. We didn't do this by financial engineering. This isn't something that is no longer possible because interest rates are going to be higher for longer. There are all these opportunities. It's you have to find them off market, and you have to have a very wide net of not only brokers but operators that actually need your help on the deal side, because if you just have one city that you focus on, you're not going to see as many of these. All right, why now? The last couple of years, obviously, from what the Fed has done with interest rates to combat inflation, which has made financing extremely difficult because sellers for a while were holding on to 21, 2022 type of pricing, and they just have a hard time saying, no, I thought I could sell this for $5 million. Now you're telling me it's worth $4 million. I'll just hold out. And because they're such great cash flowing investments, if they've held it for a while, what's their incentive to sell? The problem is that life does get in the way, right? So divorces happen, deaths happen, people's lives change. They get tired. They want to retire. They don't want to operate the asset anymore. So a lot of transactions in this space is just great timing. It's just getting a little lucky and being in front of these sellers when they happen to decide, oh, you know what? Yeah, now's the time. And the group that's been reaching out to me a lot, I'll give them a call. Or the group that just sent the last letter I received, I'll give those guys a call. Unfortunately, it's sad when you hear the stories about you close a deal and then another operator hears about it and they say, I've been talking to that guy for 5 years. So it is a little random in terms of how you find deals in this space, which is why it pays to have such a wide network of people that are out there pounding the pavement looking for it. So all that being said is you tend to not want to start a new vintage for a fund, which is, by the way, why we named the company. We want to focus on great vintage years and not just always be putting money out in strategies, regardless of is it a good or a bad time, right? Those are marketing companies. We want to make sure we're putting our money to work at good timing because real estate is cyclical. When transactions are hard to do, generally that's a good time to be buying things. And we're not making predictions about what interest rates are and we're not going to do. I don't personally believe that anybody has a crystal ball with interest rates. I don't think a lot of people saw interest rates going up 500 basis points in a few months, 6 months, in 20. So we just try to focus on where is the value creation coming from and can we transact and hold over 10 years if we have to. We prefer to sell 5, 7, but if we have to hold through 10, can the net operating income increase substantially, which is going to solve a lot of problems. And if you look at this space, because you have these institutional buyers in mobile home parks, I don't think we're going back to the 8, 9 cap rate world of 75, when Sam Zell first started buying these things at just unbelievable pricing. I think it is an institutional asset class, and the fact that it is low risk from a net operating income standpoint, that you're not going to get a ton of cap rate compression. We're not going to go buy things at 6 and go to 3. I don't think that's going to happen. So you got to continue to drive assets through net operating income, which is part of the reason why we wanted to focus on that in the case studies. And that's such a big driver for the deals that we do, is because you can't count on cap rate compression. Now, the Fed tells you that they're going to start going into a declining interest rate world. And so you can make bets on whether or not that's going to happen. But I don't think you should base your entire strategy on it. So anyways, but what that does, the benefit that that has had is that it has limited transactions. And that typically is a fantastic time to be a buyer, because you just haven't had as many institutional groups go through the last few years and increase rents to market. And that is really where the opportunity, the easiest part is finding deals, throwing capital to improve them, redoing the roads, painting things, improving the water, improving some of dilapidated homes, ripping those out, bringing new ones in, improve the appearance of the property, making the tenants feel better about where they live. And then those $30 rent increases, which is frankly a decent percentage of the lot rent, like a $400 lot rent, is pretty sizable. That you can do almost indefinitely through your hold period. And that adds up when you have thousands of lots, right? Those 30, 40, sometimes 50 in a nicer market, lot rent increases do not cause people to leave, do not break their bank, especially, and they actually don't have a problem with it if you are improving the property. I can't recall one time when a tenant is like, you increase the lot rent $30, we're out of here. That doesn't happen. Now, when you increase the lot rent $300 on the $300 lot rent, you double it, which a couple of operators have done and gotten a lot of bad press, which I think is morally wrong. I don't think that's a great thing to do. That is when you get your name in the paper. That is when you have politicians come out. The vast majority of operators are not doing that, though. The good ones that are well capitalized, that are professional management teams, like the Carlyles of the world, these professional teams are not coming in there and just shooting the rents to the moon. The strength of this asset class is, once again, the length of time that you can reliably grow income. Growing income just 5-7% every year is extremely powerful when you have a certain amount of your operating expenses are fixed, and when you don't have to be throwing tons of capital every year into the asset. So that is operating leverage that really compounds over 5 to 10 year old. It's a long way of saying that I think now is a very good time to be putting new money to work. Some people want to wait for the all clear sign that, oh yeah, the Fed's back down to 3%. I think we hit 4 on the 10 year today, which was surprising. But some people want to wait for somebody to come out and announce that, okay, the real estate market is back. We backed the truck up. It's 2019 again. And that doesn't happen. By the time it feels amazing to be putting money to work, you've missed the easy returns. So we like to put money to work when things are a little bit challenging, when we feel like the market has started to stabilize. We haven't seen pricing fall off a cliff. You've seen a lot of the foreclosures in the apartment world start to work through the system. There's no cascading effect. This is not 2007, 2008. I lived that in real estate. I saw what that looked like. That was a war. This has been a challenging time, but relatively quickly, I think we're going to be through this. And the people that were putting money to work and were active starting now, and perhaps even 6 months ago, are going to do quite well in my mind. All right, fund terms. So we talked about what we're doing, the strategy. This is for accredited investors only. Debt is still 6%. So we can't be generating crazy cash flow day one. We got to put the money to work, and we got to have the properties improved. And then we'll start seeing that increase in yield as we go. If you can get 5% in a bank indefinitely, that's great. I don't think you're going to be able to do that. We'll see. But that's 5%, right? We're targeting 15 to 17%. And over a long period of time, that gets real multiples on your money. That gets real absolute cash flow back to you versus clipping a 5% yield, which is great, but that is a debt investment. This is what I think of as a combo bond equity investment because of its risk profile and historical returns it generates. So if I had to think about this in terms of where I was putting money in a portfolio, once again, I think it's in that a hybrid bucket between debt and equity because it's a fund in a recession-resistant asset class historically. So tax reporting K1, target leverage. Once again, we're not going to over leverage these things. We put 70. Oftentimes, it's at least my prior funds have all been 60. We'll see. We can go up to 70. Ironically, when it's tougher to invest, it's actually when you want to be pushing leverage, but we'll never push leverage dramatically to what we're trying to accomplish, which is making sure that we protect the downside first. Preferred return 8%. Performance fee 30 above the preferred return. So the LPs are getting the vast majority of those profits, of course. And this is a better fee structure, frankly, than I've done in the past. What's nice is that if we can just replicate what we've done in the past, you actually will get higher returns than what we've achieved previously. Management fee, pretty straightforward. These things they're not simple to run. You need to hire good people, and you can't do that on a shoestring budget. And the firms that just try to say, hey, we're going to make all of our money on profits, it's nice if they have a 10-year track record of doing that sustainably, more power to them. But I don't think you can run this investment strategy, a mobile home park diversified portfolio, without paying people that are actually incentivized to actually oversee the assets, handle tenant issues, and really deal with things in a professional manner, as opposed to just trying to scrape these things as cash cows and take all the cash out of them and only hire the cheap labor at the actual property site. Minimum investment, 100K. And the whole period here, I touched on 7 years is, I think, going to be more of the sweet spot. Probably even more. We're going to start selling a few assets, ideally in that 5-year range, because once again, I think it's a great time to be putting money to work. And if you get better debt terms in a few years, that's a great time to refinance, or that's a great time to sell, because then you get compensated for that improved capital market scenario. But we obviously don't count on that. We don't underwrite that in our IRRs. We're not underwriting a bunch of refinances that may or may not happen. However, historically, it has happened for us. And so that is something that I really appreciate doing as an investor myself. I love it when a refinance happens and you maintain ownership in the asset for more years. And so we will likely do that. And then to the extent possible, if somebody does have something come up, we understand that life happens, and then we try to do our best to accommodate liquidity if somebody really needs it. Of course, this is a private asset. And if everybody came to us and said that their child was getting married and needed 50 grand to pay for the wedding at the same time, that would be tough, right? This is real estate. These are liquid assets, but we do like to try to help people out that have something pop up. So we do allow for dividend reinvestment. And this is just basic math on how dividend compounding works, but this isn't intuitive for most people. So I like showing it. And while this isn't a 20-year fund, we do plan to continue to have, more investments, especially in the mobile home park space, for 20 years past this fund. But the idea is that this really starts getting powerful past year 7, 8, 9, 10, when your profits are compounding on top of profits, and that dividend check all of a sudden becomes a big part of your just daily or your monthly expenses, which is what I love about investing, is seeing that monthly income from various investments come in and slowly increase and then become a larger component of your monthly, not from an expense standpoint. And all of a sudden your investments are paying for your mortgage. That's how I like to think about investing, is this compounding of cash flow over time, which is why we allow for people to reinvest their dividends. And these are just quotes that make you think about, hey, if I want to achieve a different type of return, I have to do different things. And mobile home parks are certainly different from an investment standpoint. It is a niche asset class. We are not doing core apartment buildings where you try to replace the fridge and do stainless steel appliances and come up with a cool community room and then all of a sudden double the rent. There's a lot of people doing that. That is a much more efficient market. There are some people that are very good at it. And as we've seen, there are plenty of people that were pretty lousy at it. This is out there in terms of what's in most people's portfolio. And that's why I think it has such a unique risk reward setup. And so these are just quotes to remind me personally, not even you guys, but just to think through what we want to focus on. We want to focus on unique investments that have some sort of weird dynamic to them where you're getting more return relative to the risk. All right. And so who is this fund good for? It's not for everybody, that's for sure. But if you are accredited, you want to do this with somebody that is not experimenting. This isn't our first rodeo in mobile home park investing. Somebody that realizes, most importantly, the deals that you need to avoid. I don't think you want to go with a firm that did apartments for 10 years. And now, because that didn't work out, let's do a mobile home park. I think you want to go with people that have seen good and bad in this space and cut their teeth and know that it is operational heavy. Make sure you have the right people running the properties. That's what this business is all about. Vintage is about funds, right? We are not going to send you, hey, here's one mobile home park or here's one industrial building that we think is going to hit a 24 IRR based on these great variables. Sure, those deals are fine, and a lot of them do quite well. And so we talked about the wider dispersion of outcomes. We were focused on funds. We were focused on not losing money. I had a property in one of the funds that was completely flooded, that if it was a SPV, which is one asset, would have been traumatic for all people involved. But because it was in a fund and the other properties did very well, it was no big deal to the investors. Every investor made great money on that fund, but would have done very poorly in that asset. I don't want to have that happen. So Vintage is focused on funds. And last point on this, if investors want to do a portfolio of those, I think that's perfect. If you have the time expertise to be evaluating single deals, that's great. And I've done single deals before. But if you don't have the capital to write 10, 100,000 plus checks, if you don't have the time, that's probably not a good idea, because you've taken a large chunk of your net worth, your portfolio that was meant to be your real estate allocation, you put it into one specific asset that can have all kinds of things happen to it, of no fault, even of the sponsor. Plenty of things can happen. This is an unpredictable world. So anyways, that's just my soapbox story on trying to diversify if you're not doing this on a semi full-time or somewhat professional basis. 6, that feels pretty similar to 2, a little redundant there, sorry. And then 7, you're reasonable. This is not a stock that you can sell tomorrow. So we want to make sure we're working with good people, right? I'm not 23-year-old and doing this with anybody who shows up with cash. I want to make sure that we're working with good people. And so this is a small comment on that. All right. Ian, do you want to talk through some of the operating aspects?
Yeah, if you're ready to move forward on this, obviously we are happy, before I talk about any of these steps, we're happy to get on individual emails and or calls with anyone who wants to learn more. We very much enjoy getting to know our investors on an individual basis. If at whatever point along that process you're ready to invest, we try to make that as simple and straightforward as possible. We use an online platform called Juniper Square. That's probably the largest investment management platforms in our space. So we can send you a link to that, fill out a very simple subscription agreement that'll also allow you to review the underlying legal docs and obviously this presentation. Happy to walk anyone through that if you encounter any difficulties, but it is pretty straightforward. And once you've completed that, then you're ready to fund the deal. So typically that'll be done by wire. We can also accept checks. And then everything is done through that portal. So you'll expect quarterly investment updates. You'll expect monthly distributions. That's all familiar territory for us and something that we do across all of our assets.
All right, great. Thank you. Let's get into some Q&A now.
Great. So I'm just looking through what's coming in. It sounds like people are curious about how we're sourcing deals, and that relates to geography. Just give us some
Yeah.
of that.
Yeah, so we heavily, as I touched on the network aspect of this, I learned my lesson in my first few properties in the first fund that I did, that you cannot do this on a shoestring budget with cheap labor from 2,000-3,000 miles away. You just can't do it. You can find an 8 cap in some Ohio or Indiana market that looks great, that has 10% park on homes and all the things checked out. But if you don't have a professional system, an operations team that is like SEAL Team 6, that has an engineering focus to it, where if this happens, we do this. You need systems. You need to know exactly who's doing what at all times and have a layer of people that are there or very close by to run these things. So we heavily leverage operators. So instead of us going out and finding every deal individually, we partner with people, boots on the ground, people that I have invested with, many of them for 5+ years, that I know quite well and have delivered over and over again. And then that gives us this very diversified, both regionally and from an operator partner standpoint, portfolio that I think is incredibly resilient and has proven in what we've done in the past too. And I think that is actually a much better business model for investors than, hey, we raised a few million and this is our first go at it, and we're going to close with no margin of error to keep reinvesting in properties when inevitably things go wrong. And as I touched on, these properties that are run by pumps, they just are way more casual with the amount of money that they are reinvesting in the properties. And so the bulk of the money that you put out, you want to be doing it early. And to do that, once again, you need the construction crews, you need home movers, home centers, you need home salespeople. You can't do that in 10 different markets unless you have a 200-person team where you've brought in private equity. It's best to partner with people to enable to do that in those markets. It's just my take, and it's worked for us. And as far as where we're going, I am very much focused on red states and the Sun Belt. And that has been from personal experience, not just the overall temperature that we're seeing in the Northeast, some of it in the Pacific Northwest, although not quite as bad. But the attitude towards landlords is alarming. And we just rather would avoid that runoff and thereby avoiding a lot of the rent control. I mean, in one of the funds, we couldn't evict in a New York property, we couldn't evict a tenant for 3 years, which is, it's insane because insurance was going up, property taxes are going up. You need to be able to collect rent in order to maintain the property. So we are avoiding landlord unfriendly states. And it's not to say that we won't look at a deal in Washington. There's pockets where these will work, and it's all dependent on how much room's in the rent, the business plan. But for the most part, we're going to be avoiding those type of states. And we will dip our toe in the occasional Missouri and Wisconsin, I think is generally an awesome market, but those won't be the primary. North Carolina is one of my favorites, Tennessee, Texas, Florida, every once in a while, a deal will come through. So we like that part of the country.
Perfect. Okay. So before I ask the next one that's on here, thank you for the questions that are coming in. Is the 2% management fee based on total value of assets in the fund or on the equity portion? No. So that's based on the equity portion. It is not
Including
it is not charged on the debt leverage that's used. What is the tax treatment? Is it Schedule K1s by each state that you have a mobile home park?
Yeah. So we are going to do K1s. And then thankfully, there's a lot of other states that we do that will let us do a composite return. And because of the depreciation, the tax requirements for those states is not that significant. So the composite return, we can simplify the tax return so you don't have 15 different states, which you're not going to that many states anyways. But so we can condense the tax return to something reasonable. And then, K1s, because we want to be able to pass through those tax saving benefits, which you cannot do if this was a 1099. If this was an open-ended fund, if this was, we're going to keep this thing going for 30 years, we would do something more friendly like a 1099. But this is a defined close-end fund where the tax benefits are going to flow through to you.
All right. And then the next one we've got relates to environmental factors. With increasing climate change, increased hurricane severity, flooding, fires, etc., and these properties being more fragile, how do these costs to repair and associated vacancies impact the returns and what risks are insured?
All I can say is what I've actually experienced over the last 10 years. And I have experienced every single bad weather event that you could probably think of. I've had hail, hurricanes, trees falling through roofs, a flood. I've had so many things going wrong weather-wise that we expect these things to happen and continue to happen. The defense against those things is diversification, right? We talked about that. I had a park flood where the properties that didn't flood, right, we're able to overcome the losses from that one particular asset class. And so I don't think anybody can give you an answer on weather. Nobody knows what's going to happen. So we just avoid generally coastal properties. I don't look at Corpus Christi. Like deal comes through, operator sends something, needs help pulling it together, broker sends it, ignore it immediately, even if it's a perfect deal. I'd rather avoid that immediate kind of hurricane risk, even though there's plenty of people that take all kinds of hurricane risk and once again, just buy a lot of properties along the coastline spread out. But we haven't owned anything on the Florida coastline, in the middle of Florida, fine from a hurricane standpoint. But the Charlestons of the world are dangerous. I tend to avoid those. The key point is making sure that you're spread it out into a reasonable amount of states, reasonable number of areas in the country. And that's about all you can do. And otherwise, what's the point of investing in real estate if you think all the weather's going to shit? So I don't think anybody's got a crystal ball there. So we just try to combat that with diversification.
Great. All right. The next one we've got is this suitable for monthly retirement income? If so, approximate ROI.
Yeah. So we pay monthly income, which I think people appreciate because the quarterly is fine too, but there's something about just that monthly check coming that it's nice to think about that in terms of replacing a salary W-2 over the long term. You keep adding these types of investment, and then all of a sudden you generate your own retirement from your investments. And that actually gives you more stability if there is a stock market crash, because you still know that you have income coming in from your various investments. So we do monthly. As I touched on the terms, it's going to be 4 or 5% in the early years as we are improving the properties, as the operators are bringing in new homes, improving landscaping, improving piping, and maybe even an expansion. So in the early years, it's tougher with 6% debt, of course, to generate the 7% cash flows, right? Because the debt's not helping. But Time and time again, I've seen it after a few years. It's pretty reliably up 5, 6, 7 after the few first years. So that's what we plan to do.
Super. All right. And the next one is actually related to that, a broader version of it. What gives us conviction? I think the asker of this question clearly understands that investing involves risk, but what gives us conviction in the 15 to 17 projected IRR?
We've done it in the past, which that's helpful. So once you keep doing things, you start to feel more confident in your ability to pull it off. Part of that is the timing, the cycle that we're in. I think now is a great time to be putting money to work as opposed to 21. Turned out to be not a great time to put money to work. And the great thing about mobile home parks is because we know what the ongoing capital needs look like, modeling these things it's not putting your finger in the air and hoping, right? We know how much we're paying for the property. We know what cap rate should be year one after a modest rent increase. And then because there's so much operating leverage in the business model that we know what cash flows are going to look like. And okay, so $30 lot rent increases. All of a sudden that 6 cap becomes an 8 cap pretty quickly. So that's a 33% increase over a couple of years. And then you do a few more of those and you pass through water. And then all of a sudden you've doubled the NOI after 5 years. And so after 5 years if you sell then, that's a 15 IRR. So the cap rate stays the same. So anyways, if you get any kind of boost from the capital markets, then obviously the returns increase from there. Thankfully, this is one of the few industries you can model on the back of a napkin, fairly straightforward. Most of my career, I was doing 5-tab complicated models that frankly, nobody knew. It's like the model was just to try to help people feel better about the decisions, help the bankers feel better. Whereas in mobile home parks, there's not many things that are driving the outcomes other than lot rent, passing through the water, keeping expenses in check, monitoring the sewer and water usage that you don't have to see crazy leak. And then because you don't have that crazy capital surprise, because you're improving the park up front, and you tend to know the cash flow. So anyways, that's how I think about the returns.
Great. Okay. I think we've got time for one or two more. So there's one that's just come in. Who purchases the investments as part of the exit strategy? What do you do with those problem ones that linger?
That's the nice thing is that this is a much more liquid asset class than it used to be. When I got into the business 10 years ago, there were fewer buyers showing up for deals, which made finding the deals easier. Now we have the network that we can still find the deals, but we also then have a much more liquid sales market. So for example, in 2020, in COVID, in 2021, I sold 20 deals individually, not in a portfolio, which was painful. I would have much rather sold that in a portfolio. And now I could, because the market's even more liquid from a buyer standpoint. But partly because COVID, people just weren't buying as much. People were just taking a wait and see, like our collection's going to fall off a cliff. Are we even going back to work? But I was able to sell, being the point person, on that many deals, which was painful, but we still had that many buyers. It wasn't like we had 2 buyers. It was more like 12 buyers that bought all those. And so you can do them individually if that's what the optimization on purchase price is going to be. And I tend to think it's going to be more of a combo where you cluster some of them and we'll sell some in year 5, maybe 1 or 2, because it's just, we did the business model really quickly. The boots on the ground did an amazing job. And hey, this is time. We're not going to be able to grow the rent and decrease expenses as much as we did the first 3 years. And so maybe you do it that way. It's a bit of a hybrid. Now, there is certainly a portfolio premium if you can get enough scale to one of the private equity groups that they can't be buying a $3 million deal. But a very reliable way to make money in private equity, and not only just buying businesses, but buying real estate, actually the most reliable way to make money is arbitrage on the multiple and going from aggregating smaller deals to a portfolio that you can sell to lower cost of capital, big groups, right? Carlyle does not want to do, once again, a $3 million deal. They want to do a $30 million deal. So it gets easier once you have a larger, chunkier portfolios to sell. It's easier to sell them at a premium. But once again, I think you do what's best for the portfolio over time, and you don't just get dogmatic about one exit strategy.
Super. Thank you to everybody. That was great engagement. Really appreciated all the questions. Hopefully this was useful. And we will look forward to following up with each of you as appropriate.
Yeah, thanks everybody. Thanks for your time. We're excited to be putting this money to work. We know that the space extremely well and love investing in it and love improving these properties. And driving returns for our limited partners. So we'd love to have you aboard if it makes sense for you. Thanks.